Hello, welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest today is William Mahan, and I'm just going to call him Bill. And Bill is an attorney. His office is here in downtown San Jose at Park Center Plaza. He's been practicing law for about 31 years. He has a master's in taxation degree from Golden Gate University and also his JD degree or law degree from Santa Clara University. His practice focuses on estate planning and probate and business planning. And lately, Bill and I have both been doing quite a bit of work helping people, advising people related to short sales and foreclosures. And so I invited Bill to join me here today. Today, we're going to be focusing on the tax considerations related to short sales and foreclosures. And before we get started, I want to urge our viewers to seek legal and tax advice. So we're not going to cover it all here. This is something that you need to really get individual help for. And also, the laws vary from state to state. So that's another thing to be aware of. Bill is a California attorney. I'm a California CPA. And our laws related to how short sales and foreclosures work is a little different from state to state. So please do get that advice. Bill, thanks for joining me here today.
My pleasure.
Okay. Well, here goes. So what happens as far as the tax consequences related to a loan modification?
Okay, well, before we start, let me say that you're as much or more a tax expert than I am, so if I leave something out or you want to make a comment, please feel free to chime in.
Okay.
A modification, we spoke about in a previous program what it is. Essentially, it's when you go back to a lender and try to get the terms of the loan changed.
Yes.
And it could result in a tax consequence, particularly if there's a reduction in the principal amount of the loan. That's a type of forgiveness of debt. And anytime there's debt forgiveness, there's the possibility of cancellation of debt income. So I would consider that to be the primary tax consequence that could come out of a modification.
Okay.
If you change the interest rate or you change the term of the loan, that shouldn't really affect the principal amount necessarily in that. So that I don't see that as necessarily an income tax problem.
Yeah. Now, there are some technical things in the regulations. I'm not going to get into them into any depth, but theoretically, there's a discounted value based on an interest rate that's happening. So there is a potential related to it. But for the most part, I think everybody's focusing on the principal reduction. Mm-hmm. So folks, one thing here, we're going to say as a general rule that the cancellation of debt income may be taxable, but then we're going to be talking about exceptions later. So this loan modification amount may qualify for an exception and not be currently taxable. And we'll be talking about that in more detail. Okay, Bill, so a big thing in this area is just what is a recourse loan and what is a non-recourse loan, and are the rules related to that consistent among the states?
Okay, I'll answer the second question first. No, the states have different rules, and so you have to be aware of the rules of the state where the property is located, because real estate is a state-by-state consideration.
Okay.
In California, we have, recourse financing is when you borrow money, and if the property is worth less than the amount of the mortgage and it's lost or sold for that amount, and there's a deficiency judgment, then the lender or the holder of the mortgage has the ability to seek recourse. Mm-hmm. So they can go after the borrower for any deficiency in a recourse.
So if there's not enough money in the property to satisfy the debt, then the lender can still try to get to other assets.
Right.
Of
the difference between what the property actually realizes and what the mortgage amount is potentially the deficiency amount.
Okay.
Plus costs, legal fees and things like that.
Okay.
In California, we have an anti-deficiency statute. So there's a little bit of confusion in that, and I always want to point it out. The anti-deficiency statute applies to certain types of properties and certain types of borrowers. The mortgage itself is not necessarily non-recourse. It doesn't say that anywhere. And when you get outside the context of single-family homes or residential properties of 4 units or less, you get into other types of properties that we're not really talking about today, like commercial property and investment property. You could still have recourse or non-recourse financing, but it probably would be part of the negotiated financing. Whereas in the residential context, you wouldn't see it on the mortgage, but if it's a certain type of mortgage where it was purchase money when the person bought the property, the borrower occupied the property, then that mortgage would qualify under our anti-deficiency statute for and be considered non-recourse.
Okay.
And the reason that matters with the IRS is because there's different tax consequences, certainly to recourse versus non-recourse.
Right. We'll get into more detail on that in a moment. So, what about second and third mortgages for purchasing a principal residence? Are those also non-recourse?
Well, they can be. They can be if you have mortgages that are taken at the same time as purchase money for the property, even if it's a home equity line of credit along with the first mortgage, it can be. It probably would be considered non-recourse financing because it's part of the purchase money of the property.
Right,
so
right.
It can be. If it's taken later, a lot of times people would buy a property and then add a second or a home equity line of credit later. And that second mortgage in that case is not purchase money because it wasn't done at the time of the purchase, and therefore it is probably recourse financing.
Okay. So, I think I'm going to leave the LLC stuff off for now, Bill, and give you a break. What is the tax consequence of a deed of trust sale of a non-recourse debt?
Okay, well, there's a couple things going on there. A deed of trust sale is when a lender opts to use the trustee sale procedure as their way of foreclosing on the property.
Right.
And if it's non-recourse financing, in other words, if it's a property that qualifies under the anti-deficiency statute, then whether or not it was a deed of trust sale or whatever it was, since it was qualified under the anti-deficiency statute, there's no recourse for the lender other than the property itself. All they can take is the property. And the tax consequences on that are good for the borrower because for tax purposes, the property is deemed to have transferred for the amount of the mortgage, not the value that was realized from the property. So if you have a $300,000 mortgage and a $250,000 value and the property sells for $250,000, for tax purposes, non-recourse financing would be considered to have sold for the $300,000 mortgage. So there's different kinds of tax, as you know. We still have to consider whether there's gain or loss on a sale, and that depends on basis and what was realized for the property. But assuming there was no gain on the transaction, there wouldn't be any cancellation of debt income because you used the value of the amount of the mortgage as a sale price as opposed to the actual value of the property.
Right. So there's two pieces of this, or I'll say at least two pieces. Okay. So one is what happens related to the debt itself. Okay. Is it satisfied? And do you have a cancellation? Okay. And if you have the cancellation, then there's the potential of income of some type related to it. Right. The other has to do with what happens related to the property. In other words, the sale, is there a sale or transfer of this property for some value? Right. And so in this particular case, since the property is being satisfied by the value of the property is being satisfied by the mortgage, or maybe the other way around, the mortgage is being satisfied by the value of the property, then we have a situation where we aren't going to have a loss that's not deductible and income that's taxable. And we'll get into that a little more related to the recourse example maybe in a moment. So how about a short sale then with non-recourse debt?
Well, this is another area that, in my opinion, that has evolved. There was a concern, and we've had earlier discussions in past years about what happens in that situation in a short sale, because a short sale is not a foreclosure.
Right.
It's an agreement between the lender and the borrower. And so there was a question about, it's not under the anti-deficiency statute, so if it was a non-recourse type of a situation, does it matter if it's a short sale versus a foreclosure? Because we know in the foreclosure there's no recourse and there's also no tax consequence. But I think with the changes, the recent changes in the short sale statute, if you have a short sale that's agreed to by the lender, and we've also discussed in the prior program that that's a type, I think, of anti-deficiency protection, and so I think it really would have the same consequence now. I mean, I know that we were relying earlier on case law to say that if you made the short sale, if you made the cancellation of the mortgage a part of the short sale, that was going to eliminate a potential tax consequence. But I think my feeling is we don't have any real law on this yet, but my feeling is that the statute probably changes that a bit because it should be the same effect, I think.
You know, and part of what's confusing about these things is that because of the way that the anti-deficiency laws work, even related to recourse debt, this isn't going to be something that's going to be litigated in a sense between the lender and the borrower. Right. I mean, the consequence is determined, okay? It's more of a thing now, okay, well, what is the tax result? And some of these things we may not really know for some time. But what we've been doing, as Bill has said, is that there is a decision, it's called the Briar Park decision, that we've been depending upon. And the IRS seems to be following it, from what I can tell, like in their IRS publication and so forth, that basically says that we treat the short sale the same as we would as a foreclosure. And so we're treated as a sale of the property for the entire amount of the loan, even though the bank has settled for a lesser amount. Right. And so, and it's a cash deal, so it's not a matter of, you know, a property being satisfied. So it's really it's kind of strange, but it's the result that we would like to see, so we'll take it. Okay.
Yeah, and the statute I was referring to is a California statute. Again, like it varies from place to place, but we do have a new statute in California, and I think the result should be the same. It started out non-recourse, so that's your example of non-recourse.
Yeah.
It shouldn't have a tax consequence. I think that's the right result.
Okay. All right, so let's get into, what about the tax consequences for a foreclosure with a recourse debt?
Okay, so if we have a trustee sale or a foreclosure, we've talked earlier about the difference between judicial foreclosure and trustee sale. Both of them are a type of foreclosure. So the property is taken back by the lender or the holder of the mortgage in some kind of a procedure. And now you have a debt that if the mortgage is recourse, then that lender should have the right to pursue a deficiency against the borrower. However, as we know, in the trustee sale situation, when they elect to follow that procedure, they waive the right to pursue a deficiency.
Now, this relates to only certain types of property, isn't that correct? So again, this is the owner-occupied.
Well, no,
not just. I'm sorry, not owner-occupied, but basically it's residential property up to 4 units. Correct?
Well, no, I'm talking really about the consequence of a recourse. Of the foreclosure on a recourse note.
Okay, so when a lender...
the trustee's provision is for single-family property,
okay,
right?
Okay.
The waiver of that,
okay.
And I'm really primarily talking about single-family properties or technically 4 or fewer residential units. So residential property, I'm not trying to discuss commercial transactions.
All right.
Because I think the audience here is probably more the home buying public.
Okay, just wanted to clarify that.
Right, okay, thank you. So what we're talking about is we have a deficiency.
Yes.
If the lender pursues the deficiency, this is important for people to realize, until they stop pursuing the deficiency, you haven't had any cancellation of debt.
Right.
So you have no income tax problem.
Right.
But as soon as the lender does something to stop pursuing a deficiency, which in the case of the single-family residence, if they did the trustee's sale procedure, they would waive their right to a deficiency. Then it raises the issue of whether or not there's a cancellation of debt, because the property, in this case, the value of the property is considered to be what it transferred for. And if the mortgage is more than that, then the difference between the two is potentially cancellation of debt income, COD.
Right.
Right? And so now we have an income tax problem.
Right. So, again,